As we have discussed, the central problem in finance or business decision making in general is how to value assets or their cash flows. A cash flow, in addition to its magnitude, has two key characteristics, as we have discussed before. It's timing and risk. We are now going to develop a simple model to capture the two essential elements in finance, time and risk. We assume that there are two dates for the economy, today and tomorrow, or now and future. Denoting time by t, t equals 0 for today and 1 for tomorrow. Sometimes we also draw a horizontal line to represent time, the timeline, as shown at the bottom on the right-hand side of the slide. The two dates are marked as 0 and 1. For day 0, there's no uncertainty, but for day 1, there is uncertainty. We describe this uncertainty by assuming that there are n possible economic states at day 1, such as boom or recession. We denote the state by S, and it can be 1, 2, or n for state 1, 2, or n. The likelihood of these states are given by their probabilities, P1, P2, and Pn. The n states can also be represented by the n branches at time 1, as in the graph on the right-hand side of the slide. We assume that the possible states and their probabilities are known to all decision makers. The tree graph on the right-hand side of the slide with the associated probabilities is also called a state space model for the economy. Ideally, the state space model fully captures the risk of the economy. The simple model described here may seem a bit too simplistic for that purpose, but it can be extended easily to allow many dates in many states, even a continuum of states. We will consider some of these extensions later. But for now, our main purpose is to have a simplest model to capture the key elements needed for our analysis and to develop the basic ideas, principles, and methods for asset valuation. For this purpose, we often even reduce the number of states to 2 for simplicity. We now consider a financial market with no frictions in this economy, with the set of financial assets being traded. Assets can be traded at time 0 and their payoffs realized at day 1. Let P denote the price of an asset at time 0, X denote its payoff at time 1. The value of X in general depends on the state of the economy at time 1. It will be X1 in state 1, X2 in state 2, etc. X can also be represented as a vector of different payoffs in different states. It's also called a random variable, denoting unpredictable realizations at some future time. A random payoff is fully defined by its payoff in each possible state and the corresponding probability. Mathematically, we can write it as a payoff vector, with each element of the vector denoting the payoff in that state, x1 to xn, together with the corresponding probabilities, p1 to pn. Assets traded in the financial market can have different payoff patterns. In general, there are many traded assets or securities. Here, securities refer to financial claims, contracts traded in the financial market, such as stocks, bonds, and derivative securities. We first introduce some simple securities. Consider a primitive state contingent claim, which pays $1 in a single state, S, and nothing otherwise. It is also called an Arrow-Debreu security, named after the two economists who first introduced them into financial market modeling. Although arrow the blue securities are not the most visible or common securities seen in the market, they do exist in mature markets. Introducing them here is to facilitate our analysis in the simplest way possible. As shown later, their actual existence is not essential as long as we have a rich enough set of traded securities like bonds, stocks, and derivative securities. We will denote the price of the arrow the blue claim on state J by phi j. Phi j is also called the state price for state J. State price turns out to be a very useful concept in our valuation analysis, as we will see throughout this course. No arbitrage requires that all state prices are positive. A security that pays off a positive amount, at least in one future state, must have a positive price today. Otherwise, we can construct an arbitrage. Since there are a total of n states, there are also n different arrow the blue securities. A financial market is called complete if all the n arrow the blue securities are traded in the market. Complete market is a useful abstraction, as we'll see soon. It merely means that the financial market is rich enough in terms of the securities being traded in the market. As we said in the introduction, there are indeed tens of thousands of securities being traded in the global financial market. For most of the applications we discuss in this course, assuming a complete financial market is a reasonable starting point. More discussion on this point will occur when we develop more detailed risk and valuation models. With a complete financial market, we can develop a general methodology to value assets using the market prices of traded assets. We will start with a market in which a complete set of arrow the blue securities are traded. With the prices of these arrow the blue securities, we can price other assets, securities, or cash flows by using the first principle of finance. There's no free lunch in a financial market without frictions. With the prices of the arrow the blue securities, we can price other assets and securities. To illustrate this idea, let's consider a two-state economy in which we only have two states for day one. We have three assets traded in the market. The first two assets are the two arrow the blue securities, one paying $1 in state 1, 0 in state 2, and the other paying $0 in state 1 and 1 in state 2. The third asset has a payoff X, paying $3 in state 1 and $5 in state 2. The question is, how is the price of the third asset related to the prices of the first two, namely the two arrow the blue prices or two state prices? In order to answer this question, we can think of the third asset as a portfolio of the first two assets, namely the two arrow the blue securities. In particular, we can think of it as being a portfolio of 3 units of the state 1 arrow the blue security plus 5 units of the state 2 arrow the blue security. In this case, the portfolio would pay $3 in state 1 coming from the 3 units of state 1 arrow the blue security, and it will pay $5 in state 2 from the 5 units of state 2 arrow the blue securities. The claim is that the price of this asset X is going to be given by the following equation, namely its price should equal to 3 times the state 1 state price plus 5 times the state 2 state price. Since the third asset can be replicated as a portfolio of the two arrow the blue securities, namely 3 units of arrow the blue security 1 and 5 units of arrow the blue security 2, then by no arbitrage, its price must equal the price of the replication portfolio. Namely, its price P must equal to 3 times phi 1 plus 5 times phi 2. If this is violated, then agents can generate arbitrage profits in the market. How? Well, let's see. Suppose actually the price of the third asset P is greater than 3 times phi 1 plus 5 times phi 2. Then what we can do is actually to sell the asset 3, gaining P, and then buying 3 units of Arrow-Debreu security 1 plus 5 units of Arrow-Debreu security 2. The price difference in this case will be positive, will be our current profit. And then the net future cash flow would just be 0. So in the absence of arbitrage, we must have the price of the third asset being the same as the cost of the replication portfolio. This example shows a more general idea, sometimes called the law of one price, which states that if two assets have the same payoffs, they must have the same market price. Applying this principle, then we can price all the other securities using the prices of Arrow-Debreu securities. All we have to do is to construct a replication portfolio for a particular security and then compute its price using the cost or the price of the replication portfolio. Now, of course, this all relies on the assumption that we have the prices of all the Arrow-Debreu securities. What if we have prices of a bunch of composite securities? Let's consider a simple example. Suppose that we have two economic states at day one. In the financial market, we have two traded securities. One is a safe government bond, which pays an interest rate of 5% with no risk. The other security is a stock that pays $90 in state 1 and $120 in state 2, and its current price is $100. The question is, what should be the proper set of state prices? Well, let's see. From the price and the payoff of the government bond, we have the following equation. 100 on the left-hand side, which is the current price, equals to 105, its payoff in state 1, times the state price for state 1, phi 1, then plus 105, its payoff in state 2, times the state price of state 2, phi 2. From the payoff and the price of the stock, we got the second equation. 100, again, its current price, equals to 90, which the stock's payoff in state 1 times phi 1, plus 120, the stock's payoff in stock 2 times phi 2. These two equations from the prices of the stock and the bond allows us to determine the two state prices, phi 1 and phi 2. If we solve for the two state prices, we got the following solution. Phi 1 equals 10 over 21, and phi 2 equals 10 over 21 as well. Here's a special case in which the state prices are identical. This example shows that actually if we have quote-unquote regular securities like a stock and a bond, from their prices and the payoffs, we can actually back out the Arrow-Debreu state prices. Now let's consider another example. Suppose there are two states next year. The payoff of a share of stock and the probabilities of the states are $90 in state 1, $110 in state 2, with the probabilities being 0.4 and 0.6 respectively. We're also going to assume that the state prices for the two states are 0.5 for stage 1 and 0.4 for stage 2. We would like to answer the following questions. 1. What is the stock price today? 2. What is the expected rate of return on the stock? The stock price today can be computed easily. P should just equal to phi 1, the state price for stage 1, times x1, the stock's payoff in stage 1, plus phi 2 times x2. Plug in the numbers, it gives us 0.5, the state price for stage 1, times 90, the stock's payoff in stage 1, then plus 0.4 times 110. That gives us 89 as the current price of the stock. Next, we can compute the expected rate of return on the stock, which is denoted by R bar. R bar should equal to the expected payoff on the stock minus its price today, then divided by its price today. It can also be re-expressed as the expected payoff on the stock divided by its price today, then minus 1. If we plug in the numbers, that gives us 0.4 times 90 plus 0.6 times 110 for the numerator, divided by 89, its price, then minus 1. Finishing the computation, we'll get the expected rate of return on the stock to be 13 divided by 89. Given the expected rate of return on the stock by the market, we also have the following expression. The price of the stock times 1 plus the expected rate of return on the stock should equal to the expected payoff on the stock. Rewrite this equation, we have the price of the stock being given by the expected payoff divided by 1 plus the expected rate of return on the stock. Plug in the numbers, we have 102 for the numerator, and then 1 plus 13 divided by 89 for the denominator. Finishing the calculation, we got 89 as the price of the stock, which is exactly what we got before. So there are basically two ways to compute the stock price today. One is by the state prices. The other is by the expected payoff, then discounted by the expected rate of return on the stock. Both methods give us the same answer. In general, in a complete market without frictions, we can value any cash flow by the no arbitrage principle, the first principle of finance. Suppose a firm is considering a project yielding time 1 cash flow X, which is X1 in stage 1, X2 in stage 2, etc. Using the prices of arrow to blue securities, we can then attach a value to this cash flow as follows. Its value should equal to phi 1, the state price in stage 1, times X1, its payoff in stage 1, plus phi 2 times X2, and so on. And that gives the current market value of the project or the cash flow. This valuation formula encapsulates the relative or arbitrage pricing principle, which we're going to be using for our future analysis. PV here is also called the present value of the project or asset or the cash flow. As we have seen in the previous example, the present value, PV, is also given by the expected payoff of the asset and then the expected rate of return on the asset. The key idea here, when it comes to value an asset, is to find traded assets with similar cash flows, both in timing and risk, and then use their prices or the expected return to value the particular asset we're interested in. Using market prices or expected returns of traded assets, we can value a particular asset, project, or cash flow, its current market value or present value. We now expand on this idea to further develop some techniques to value a cash flow or to compute its present value. We will do so by starting with a couple of examples. They are extensions of the simple examples we considered in the introduction. We will start with the simplest case possible. That is $1,000 of a saved cash flow in 1 year. The question is, how much should that cash flow be worth today? Let's suppose that in the market, similar assets, namely safe assets, are offering an annual return of 2%. Think of a potential buyer of this cash flow. She would also expect a 2% annual return, same as what other safe assets offer in the market. Let the price she's willing to pay be P, then we have the following equation, namely P, which is the price she's paying, times 1 plus the 2%, the return she expects to get. That should equal to the total cash flow at the year end. That's $1,000. We can solve this equation for the price, P, which would equal to $1,000. That's the expected cash flow in this case with certainty, divide by 1 plus the expected rate of return, 2%. If we finish that computation, we're getting P to be $980. This is a rounded number. So this is really what any investor in the market will be willing to pay, which is also what we call the present value or the current market value of this cash flow. It's really given by the expected cash flow from this asset, in this case $1,000 for sure, discounted at the required rate of return of 2%. So this formula is sometimes also called the discounted cash flow formula, namely the value of a cash flow or asset is given by its expected payoff discounted at appropriate discount rate. Now, of course, we realize this discount rate really reflects the time value of money. It adjusts for the fact that $1,000 is occurring not now, but 1 year from today. In the second example, we're going to assume that this $1,000 in 1 year, it's no longer certain, but rather it's risky. The question is, how much should be worth today? Let's again look at the market. Suppose that traded assets of similar risk offer an expected annual rate of return of 20%. Well, given that, we can easily compute the current market value for this cash flow of $1,000 in 1 year. The potential buyer, again, would expect a 20% return on this by paying the current price, let's say P. So by looking at this equation, P times 1 plus 20% should equal to $1,000, the expected payoff from this risky asset. The present value of this cash flow then is given by this simple discounted cash flow formula, namely $1,000 of expected cash flow discounted at the 20% rate of return, which is the market's expected rate of return for assets with this level of risk. If we finish the calculation, that gives the present value or the current market price for this cash flow of $833. As we noticed, the discount rate here of 20% is quite a bit higher than the 2% in the previous example where the cash flow is certain. This actual rate of return reflects the risk premium. So the present value formula really probably adjusts for risk by choosing the appropriate discount rate for assets with same risks. From the two examples, we can generalize. The current market value of a cash flow or its present value is determined by two factors. First, its expected payoff. Second, an appropriate discount rate, where the discount rate is given by the expected rate of return on traded assets with similar cash flows in both timing and risk. In particular, the present value of a cash flow is given by its expected cash flow discounted at an appropriate discount rate, R bar. Therefore, the value of an asset or cash flow is determined by the financial market through the discount rate or expected rate of return or required rate of return. They all mean more or less the same thing. The discount rate here should properly adjust for time and risk of the cash flow. The discount rate is also called the opportunity cost of capital because it is the return offered by similar assets traded in the market. The present value looks at the current value of a future cash flow by discounting back at the appropriate discount rate. We can also consider the future value of a cash flow today by allowing it to grow at the proper rate of return. Suppose that we have $1 today. What would be its worth in 1 year if the interest rate is 4%? Well, we could certainly invest that $1 in the market, earning a rate of return of 4%. In 1 year, that $1 would turn into $1.04, where 4 cents will be the interest on the $1 initial investment. So $1.04 will be the future value of $1 in 1 year at the market rate of 4%. What about its future value in T years? Well, we would just have to multiply 1 plus the interest rate T times. So the future value of $1 in T years will be 1 plus R raised to the Tth power. Let's consider a concrete example. Suppose a bank issues a CD with an annual interest of 4%, and this is a 2-year CD. Suppose that you deposit $10,000, what would be your balance in 2 years? It would just be $10,000 times 1 plus the interest rate of 4%. Raise it to the power of 2. And in that, it will give us $10,816. And that is the future value of $10,000 today in 2 years. Business decisions often involve choices between different alternatives. Each alternative may involve a stream of cash flow with many pieces. Comparing these cash flows is not trivial given that they have multiple pieces. Let's consider the following example. A drug company has developed a new flu vaccine and needs to choose between two strategies. Strategy A is to bring to market in 1 year, invest $1 billion now, and returns $500 million in year 1, $400 million in year 2, and $300 million in year 3. Strategy B involves bring the vaccine to market in 2 years, investing $200 million in year 0 and 1, and then returns $300 million in year 2 and 3. How do we make a decision between strategy A and B? In particular, how do we value or compare these two strategies or their cash flows? Of course, the cash flows of the two strategies, being multidimensional, cannot be easily ranked. With the present value, however, the ranking becomes simple. The present value of a cash flow or its current market price is a number, a scalar, which can be easily compared. First, we note that the present value of a stream of cash flow is simply the sum of the present value of each piece of the cash flow as given in the present value formula here. Suppose that the right discount rate is 5%, we can then price the two strategies easily. Let's first consider strategy A. Its cash flow in period 0 is minus 1 billion. And here the numbers are in millions. In year 1, it's going to return a positive cash flow of 500 million. In year 2, 400. In year 3, 300 million. With the discount rate of 5%, we can easily compute the present value of each piece of this cash flow stream. 1 billion today is 1 billion today in present value. $500 million in year 1 would be 476.2 million in present value terms. $400 million in year 2 would be $362.8 million in present value terms, and so on. If we add up the present value of each of the pieces, we get $98.2 million. That is total present value of strategy A. We can then do the same for strategy B. The cash flow from strategy B is given by the second row in the lower panel in the table, and the present value is given by the third row. If we add up the present value of all the pieces for strategy B, we get $140.8 million. Now, with the net present value for strategy A and B, respectively, we can easily make a choice. Clearly, strategy B will give us a higher present value, and that is a better strategy. This example shows if we can value each of the alternatives, the final decision becomes straightforward. Pick the one with the highest present value, assuming it's positive. We will see more detailed applications later in corporate investment decisions. Before moving on, we want to talk a bit about the unit for measuring cash flows. They are typically measured in nominal dollars, which we call the nominal cash flow. However, what we really care about should be the actual purchasing power of a cash flow, which is also called the real cash flow. When there's inflation, which is present in almost every economy, these two can be quite different. Let's consider a simple example. Suppose that inflation is 4% per year, and you expect to receive $1.04 in 1 year. What is the real value of this cash flow, namely its actual purchasing power? What we need to do is to adjust for inflation. The inflation adjusted, or the real value of $1.04 in 1 year, is given by its nominal value, namely $1.04, deflated at the annual inflation rate of 4%. That will give us $1. That is the actual purchasing power of this cash flow in 1 year, namely the real cash flow. In general, if the annual inflation rate is I, and if we're looking at a nominal cash flow CFT in year T, the corresponding real cash flow at time T would be the nominal cash flow discounted at the annual inflation rate T times. We can do the same for rate of returns. For rate of returns, the prevailing market rates that we see in the market, for example, the interest rates quoted by banks, are typically nominal rates of return. But what we should care about will be the real rates of return, which are inflation adjusted. We can actually look at the following example. Suppose that we have $1 to be invested in the market, and the market interest rate is 6%, which is in nominal terms. That means that $1 we put in the bank would turn into $1.06 next year. But if the inflation rate is 4% per year, the real value of this $1.06 is just $1.019, because we have to discount it by the annual inflation rate of 4%. This then gives us the real rate of return, which will just be 1.9% rather than the nominal 6%. If we do this in general, the real rate of return should equal to 1 plus the nominal rate of return deflated at the inflation rate I, then minus 1. In the case that both the nominal rate and inflation are small, we can also approximate this by just the difference of the nominal rate minus the inflation. Let's now consider a concrete example. Suppose that sales is 1 million this year, and it's expected to have a real growth of 2% over the next year. Inflation is expected to be 4%. The appropriate nominal discount rate is 5%. What is the present value of next year's sales revenue? From the information given above, next year's nominal sales forecast should be 1 million, which is sales this year, times 1 plus 2%, the real growth, times 1 plus 4%, which is the inflation. That gives us $1.0608 million in terms of nominal revenue next year. Its present value should be 1.0608 discounted at the nominal discount rate of 5%. That gives us $1.01 million in present value terms. We can also do this calculation or valuation using cash flows and discount rates in real terms. Next year's real sales forecast will be 1 million times 1.02. That's the real growth. That gives us $1.02 million in real revenue. Then the real discount rate should be 1 plus the nominal discount rate divided by 1 plus inflation and minus 1. Finishing that gives us 0.9615%. That's the real discount rate. Then using the real cash flow and the real discount rate, we can also get $1.01 million in present value terms. What this example shows is that when it comes to the valuation of cash flows, we should treat inflation consistently. If we're going to use nominal cash flows, then we should be using nominal discount rates. If we are using real cash flows, then we should also use real discount rates to discount. It doesn't matter which one we use, as long as we use both the cash flow and the discount rate in the same unit, we'll arrive at the right answer.